this like nuance of like people, employees wanting to join companies that have really high valuations never made any sense to me. I think it's just like feeling like you're part of the cool kids club, but not actually like a rational economic decision. Like what you really want to do is join the company that the public markets, or at least the late stage private markets, haven't yet realized is awesome, because you show up at an earlier price and then you get to participate in the appreciation. But I don't think people really understand how this works. Generally speaking, I think they think of it as like a stock price that is, I'm not sure, to be honest.
It's actually, I mean, we've debated, you and I have debated, not here, but offline about like the price per share and whether or not people, employees, like actually understand that the price per share is entirely arbitrary and doesn't reflect anything like about the business value. And I was talking to a buddy the other day and we were talking about two companies, and I was like, oh, what are they worth? And he's like, well, I mean, it's a lot bigger. It's $15 a share and the other one's only $4 a share. And I was like, wait, what? Like, that doesn't mean anything, right? And so I will say the level of sophistication, it's obviously gotten better than what it was, 15 years ago. But I'm still amazed at some companies will like give you the number of options, but not like disclose what the last round price per share was, right? And it's like, how can you internalize any of this stuff, right? And like what this actually means for you. And so I would be surprised. I would guess that like, half of rank and file employees at these orgs don't know what the price per share, like that is just an arbitrary number that doesn't really reflect anything. And then the number of people that are actually getting into the weeds of like the upside and the valuation, that was why it was so dangerous when Ryan Breslow, who's been on the podcast and has been very nice to me, but when they were doing loans to people that were, at their $11 billion valuation with personal recourse, right? It's like how much sophistication can ultimately people have in understanding the risk return of the macro environment and who is investing at what price and what that means for you. And I don't know. I mean, we've now seen that Bolt announced they're laying off 250 people, and hopefully there aren't a ton of people with these personal recourse loans, because I have to imagine like there is a buffer there, but not a huge one. And if Bolt's now worth $1 billion and not 11 billion, people are going to come calling for those loans, right?
Well, I think they're just going to eat it. Like that's my guess in the Bolt situation. They're going to eat the cash, and so be it, because the rest of their employee base will revolt if they start calling, debts from like former employees. I mean, that's just not a good situation for anybody.
I think the way it's structured, I think you have to, the employee has to be on the hook for some percentage of it because of tax related reasons, right? And I think it was like 51% that the employee had to be on the hook for versus the company, but it wasn't, I'm pretty sure it couldn't be 100% to the company and forgivable, because if it's them forgiven, that's a taxable event as well, right?
Give like a few Wilson Sonsini lawyers a few months and someone will figure out how to do this. And I just kind of believe ultimately like the lawyers and the accountants will figure out something here. Do I have the exact solution? No, but I know somebody who bills $2,000 an hour does, and they'll figure it out over time. I will say I have found that more startups have like better habits about price disclosures on preferred, on 409A. They're giving calculators. Like even at Flatiron, when we started, this is in 2012, we would give a calculator. Now it's up to you as the employee to plug in what you think the like long-term expected value is. We're not guaranteeing an outcome, but we would tell you, here's the latest preferred. Here was the preferred before that. Here's the 409A. Here's the strike price. Here's the number of fully diluted shares. Here's how you do like a little bit of math. Here's future dilution expectations. Up to you to plug a number in. And you can give like a calculator to somebody and let them go through it. Now, it's complicated. And I think sometimes people look at it and go, I don't even know where to begin. But I think the habits have improved. I just think people have never been through a crisis. And so it never crossed their mind that like you would see an actual reset, and like, what do you do in a situation when your preferred is now below your last 409A, and like, how do you reset this stuff? And it's just that it's, eventually like this will work itself. It'll work itself out.
You have to imagine that, like, just statistically, if the average venture backed startup today, what percentage of people like were in the workforce in 2008, right? And I would guess that the average venture back, like my portfolio, most companies average age of like 27 to 29 probably. And so none of those people were in the workforce in 2008, let alone, and 2008 wasn't even that bad from a tech sector standpoint, right? It was bad from like a macro standpoint, but the tech sector really weathered it. And so then you go back to 2001, and that number has to be single digit percentages at these companies that have gone through like a real downturn and what that looks like. And so, yeah, I imagine, I mean, there's a lot of lessons to be learned from that time, and there aren't a lot of people that have actually learned them.
Yeah, I mean, you can just look at the age of the CEO and you can
Yeah.
tell. I mean, I feel very fortunate. We started our first company in 2007. We raised our first round prior to the crash. I watched multiple companies go bankrupt. Some of our customers go bankrupt, dollars get pulled. I mean, I was probably 20 years old when it happened, but definitely remember it and have used that fear, if you will, in some of the operating work I've done. And then definitely like staying rational on price from an investing standpoint, or at least attempting to.
Yeah.
Yeah. I mean, if your founder CEO is less than 35 or so, and that's quite a few, especially in kind of like a modern software context, they've probably never been through it. And by the way, even if they were going through it, they were probably doing it as like a fairly junior employee at the time. And so like,
Totally.
did you really experience this? Like, yeah, it's going to be interesting to watch the younger founders kind of manage through this, both the communication and also just like, what do you do? How do you reset prices? How do you communicate the stuff to founders, anyway, I always view this ultimately as like a little shakeup is a good thing. You need some like rational actions in the market, and good stuff will come out of it eventually.